the market bottom yet? Every now and then we will see articles or videos about whether the market has bottomed already. And one of the tools that is commonly spoken about is the VIX index. It seems that some investors believe that we can use the VIX index alone to gauge if the market has bottomed already. So how useful or how reliable is the VIX index in helping us to make our investing call? Hi guys, this is Hazel from the Joyful Investors. In today's video, we are going to learn more about the VIX index, how it works exactly, is it a good indicator to spot the market bottom, and does the VIX index have to spike to a new high to indicate that this is the market bottom? Let's get on with it. The VIX index measures the 30-day expected volatility of the US stock market. The calculation for the index is derived based on the call and put option prices of the S&P 500 index. So in layman's terms, the VIX index can be seen as a way to gauge the general market sentiments and the level of fear among the overall market participants, which is why the VIX index is also commonly being referred to as the fear index. So to understand how the VIX index works, we need to first understand the impact of psychology of the market participants on the stock market itself. When market participants are fearful about the uncertainties and the outlook of the stock market, there tends to be more selling pressure as the participants are fearful of holding on to the equities. So there is lower demand for holding on to equities. Hence, this pushes down the stock market prices. If you're still feeling a little lost or confused about this demand and supply concept, let me give you another example. Many years back, there was this mad cow disease. Consumers were fearful of eating beef at that time, and that caused the demand and the sales of beef to plunge. Correspondingly, the beef prices fell as well. So that's demand and supply forces. Now that you understand the logic, let's go back to the VIX index. Let's first take a look at the VIX index price movements versus the S&P 500 price movements. And in a while, we will share with you how investors are using VIX as a gauge of market bottom. Since the VIX index gives us a gauge of the level of fear, we can see that the VIX index moves in the opposite direction as the S&P 500. So when the market is getting fearful, prices of VIX increase while prices of the S&P 500 decline. During March 2020, the VIX index shot up to an all-time high of early 80s, while the S&P 500 prices plummeted. Or if you look at even more recent examples, the VIX index went above the 30s level with the Fed raising interest rates and the Russia-Ukraine war narratives, while the S&P 500 went into a correction. So what's the point of looking at the VIX if it merely just moves in the opposite direction from the S&P 500? This is where it gets more interesting. Now historically, when VIX shoots up above 30, it is usually an indication of extreme fear and extreme turbulence in the markets, and it is usually a turning point for the stock markets. In other words, once VIX hits above 30 level, we can usually expect that the VIX will come down from the peak while the S&P 500 prices will start to go back up from the low. And the good news is that based on historical data, on average, the markets generally deliver a double-digit forward return when VIX hits above the 30 level mark. With the VIX index hitting somewhere above the 30 level mark a few times in 2022, a good majority of people believe that we are not near the market bottom yet, as the VIX has not spiked to a new high like what we saw during the COVID crash. So does VIX really have to spike to a new high for us to see the market bottoming? Let's just check out some of the previous examples. Take a look at August 2015. The VIX spiked up to the 50 level mark. So you might think that this is the bottom already for the S&P 500. But just a few months later, in January and in February 2016, the S&P 500 formed an even lower low than what we experienced in August 2015. So interestingly, the VIX did not spike to an even higher high this time. But this was actually the bottom, and the S&P 500 rallied up all the way till the end of 2017. Another example, in early 2018, there was a market correction, and the VIX index spiked and even went above the 40 mark during the day itself. But this was actually just a correction of less than 15% in the stock markets. Then prices started to hover a bit before finally returning back to the previous high in 2018. And shortly after, in 2019, prices came back down again. In fact, this time round, the market pullback was even deeper than what we saw in 2018. But did the VIX spike to a new high? The answer was no. So the peak in 2019 for VIX was actually lower than the peak that we saw in 2018 for VIX index. So from these examples, we can clearly see that the VIX index does not necessarily have to spike up to a new high for the market to bottom. So the conventional wisdom that VIX has to spike in a market bottom does not hold water. While VIX can be useful to help us gauge the market sentiment on whether generally investors are greedy or fearful, it has its limitations in terms of timing our investment entries. Hence, we do not just use VIX index in isolation when looking out for possible market bottoming. We would want to always use varying sources of information or facts together to form a more comprehensive analysis of the markets. One piece of information which we look at is the percentage of stocks on the S&P 500 which are currently traded above the 50-day moving average. Historically, when this percentage goes below 20%, it is usually at a very oversold territory, and chances of a rebound in the stock market gets higher. Now, of course, you may ask, but there are a few years where this percentage plunged down to a single digit. So does that have to happen before we are near a market bottom? Not necessarily true. Well, over the last 20 years, this has mostly happened during the bear markets, such as the COVID crash or the financial crisis. Other sources of information which we and our students use to analyze market bottom include market maker analysis to see if there is reasonable manipulation in play, and also our proprietary manner of technical analysis of the financial markets, which are other topics altogether. So over the years, they have been pretty useful. By and large, we have been fairly accurate, and for those who are in our public Telegram channel, you would have known that we entered huge positions in the China market in the middle of March this year and in the US markets in early May this year. So whether those are the absolute bottom for now, time will tell. We may be right, we may be wrong, but it doesn't matter. Because what matters is that we are absolutely sure that those were fantastic prices to lock in for the years to come on the good stocks that we bought. With this video, I hope you guys now have a better understanding of how to use the VIX index. And if you have joined our public Telegram channel, you would see that we do mention about the VIX index from time to time. Contrary to popular belief, the VIX index does not necessarily have to spike to a new high before the market bottoms. Most importantly, never use an indicator such as the VIX index in isolation, because there is no one indicator which is completely foolproof. Thank you for watching this video, and if you enjoyed the video, do give the video a like and hit on the subscribe button to learn more about investing. See you again.